Central banks bought 863 tons of gold in 2025. $89 billion flowed into ETFs, the largest year on record. The U.S. national debt crossed $38.4 trillion with $1 trillion a year in interest payments alone. BRICS launched a gold-backed settlement unit, and Trump ordered the first Fort Knox audit in 50 years. Then on January 29, gold hit 55.86, an all-time high, and crashed 13% in 2 days. Everyone's asking if the rally is over. The real question is, did anything that drove gold to all-time highs actually change? Here's what's really happening and why it matters. My name is Alex, and I've spent the last decade tracking commodity cycles and central bank policy so you don't have to. I read Federal Reserve reports and sovereign debt filings at midnight so you can understand what's actually moving markets without wading through 200-page documents written in bureaucratic code. If you want to understand where gold is really headed and what it means for your money, make sure to hit that subscribe button and give this video a thumbs up if it cuts through the noise. Before we dive in, I want to know, do you own any physical metals or just paper? Let me know below. Here's what I'm going to show you. The January crash wasn't the end of gold's rally. It was a forced liquidation event triggered by one surprise announcement and a margin requirement change that wiped out leveraged positions in 48 hours. But the four structural forces that drove gold up 63% in 2025 are still intact. And when you see what those forces are, you'll understand why Wall Street's average price target for 2026 is 51.80, 19% higher than where we are right now. Let's start with what actually happened. Because the numbers tell a story most people missed, gold gained 63 to 65% in 2025. That's the strongest annual performance since 1979, the year gold went parabolic before the famous crash. But here's what's different. In 1979, gold rallied on inflation panic and then collapsed when Paul Volcker crushed inflation with 20% interest rates. In 2025, gold rallied while real interest rates stayed elevated. That's not supposed to happen. Gold is a non-yielding asset. When real yields are high, investors should prefer bonds, but they didn't. Gold set 53 all-time highs during 2025 alone. It surpassed $4,000 an ounce for the first time in October. And by January 29, 2026, it hit 55.86. Then it crashed to 47.45 in 2 days, a 12 to 13% drop. The worst precious metals day since 1980. Silver crashed 31% in the same window. Combined precious metals market value lost an estimated $15 trillion. And then gold bounced 6% in a single day, the largest intraday gain since 2008. By February 4, it had recovered to 49.50. As of February 5, it's trading around 48.40 to 49.20. So what triggered the crash? Two things happened simultaneously. On January 30, Trump nominated Kevin Warsh as the new Federal Reserve Chair. Markets had priced in a dovish Fed, someone who'd keep cutting rates. Warsh is viewed as more hawkish. The US dollar index surged on the news, and when the dollar strengthens, gold weakens. That's mechanical. Gold is priced in dollars, so a stronger dollar makes gold more expensive for foreign buyers, reducing demand. But that's not what caused the liquidation cascade. The CME raised margin requirements. Gold margins went up 33%, silver margins up 36%. If you're holding leverage positions, which most traders are, you suddenly need to post more collateral. If you can't, your position gets liquidated, forced selling into a falling market. That creates a feedback loop. Selling triggers more margin calls. More margin calls trigger more selling. The crash accelerated because of mechanics, not fundamentals. Here's the thing, everyone's missing. The crash was a liquidity event, not a change in the underlying thesis. And when you look at what drove gold to all-time highs in the first place, nothing about that thesis changed. So let's walk through the four structural drivers that took gold from $2,600 at the start of 2025 to $55.86 by January. Because these are the forces that determine where gold goes next. Driver number 1, central bank buying. The sovereign bid. Global central banks purchased 863 tons of gold in 2025. That's the 16th consecutive year of net central bank buying. For 3 consecutive years from 2022 to 2024, annual purchases exceeded 1,000 tons. 863 is still massively elevated compared to the pre-2022 average of 400 to 500 tons. This isn't a blip, this is a sustained structural shift. Poland was the largest buyer for the second consecutive year. They added 102 tons. Their reserves now sit at 550 tons, which represents 28% of their total reserves. Poland's central bank governor said publicly they're targeting 700 tons for national security reasons, not diversification, not portfolio balancing, national security. Kazakhstan bought a record 57 tons in 2025. China bought gold for 14 consecutive months. Their official reserves reached approximately 2306 tons by early 2026. But here's what matters more than the absolute numbers. The World Gold Council surveyed central banks globally, and 95% of them expect global gold reserves to increase in the next 12 months. That's the highest percentage in the 8-year history of that survey. And a record 43% of central banks plan to increase their own holdings. That's up from 29% in 2024. Think about what that means. Central banks control trillions of dollars in reserves. When they decide to shift even a small percentage into gold, it raises the marginal clearing price of the entire market. They're effectively putting a floor under gold at $4,000 to $5,000 an ounce, because they're not sellers, they're perpetual buyers. Driver number 2, Western investor demand returns. The ETF tsunami. $89 billion flowed into gold ETFs in 2025, largest year on record. Gold ETF assets under management more than doubled to an all-time high of $59 billion. Holdings reached a historic peak of 40,025 tons, up from 32,024 tons in 2024. North America led with $51 billion in inflows. Asia saw $25 billion, exceeding all prior years combined since 2007. The SPDR Gold Trust, ticker symbol GLD, hit 1073 metric tons in holdings. That's a 3-year high. Bar and coin demand accelerated to a 12-year high, and in Q4 2025 alone, total quarterly demand hit 1303 tons, highest Q4 ever recorded. But here's the part that makes this even more bullish. Despite record inflows, money manager net long positions remain 30% below end of 2024 levels. What that tells you is that institutional investors are underweight gold relative to recent positioning. There's still room to run. They haven't crowded into the trade yet. When you see $89 billion flow into a single asset class in 1 year and professional money managers are still underweight, that's not a top. That's the beginning of a structural reallocation. Now we get to the part that actually matters. Everything before this was just context. Driver number 3, the US fiscal crisis. The debt bomb. US national debt is $38.43 trillion as of January 7, 2026. It's increasing at $8.03 billion per day. That's $92,912 per second. The Treasury expects the debt to hit $39 trillion by April 2026 and $40 trillion by year-end. U.S. interest payments on the debt are approaching $1 trillion a year in 2026. That's tripled since 2020. Interest is now the second largest U.S. government expenditure after Social Security. Net interest is consuming 13.85% of all federal outlays in fiscal year 2026. The fiscal year 2025 budget deficit was $1.8 trillion. The Congressional Budget Office projects $1.7 trillion for fiscal year 2026. Total debt per person is $112,966. Per household, it's $285,127. Here's where it gets absurd. 80% of all US dollars in existence were printed since COVID. That's according to Ben McMillan at IDX. Google searches for dollar debasement hit an all-time high in Q4 2025. People are noticing. They're watching the currency lose purchasing power in real time. And when they look for a store of value that governments can't print, they find gold. This is the psychological shift that Wall Street keeps underestimating. The fiscal crisis isn't theoretical anymore. It's showing up in grocery prices, in housing costs, in the erosion of savings. And when people lose confidence in the currency, they don't rotate into another currency. They rotate into hard assets. Driver number 4, de-dollarization and BRICS. The monetary reset. On October 31, 2025, BRICS launched a gold-backed settlement unit. This is not a currency, it's a settlement mechanism. But the structure matters. 40% backed by physical gold, 60% backed by a basket of BRICS currencies, yuan, rupee, riel, ruble, rand. It's built on the Cardano blockchain with 7-second settlement times. Russia and China now settle approximately 90% of bilateral trade in rubles and yuan, No dollars. BRICS Plus now has 10 full members: Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Indonesia, Iran, UAE. Combined, they hold approximately 20% of the world's official gold reserves. That's over 6,000 tons. India is hosting the 18th BRICS Summit in 2026, and de-dollarization is the centerpiece of the agenda. China's cross-border interbank payment system, known as CIPSEN, now connects roughly 5,000 banks globally. That's a direct alternative to SWIFT, which the US controls. BRICS bilateral currency swaps exceed $500 billion. Russia-China alone swap $200 billion a year in yuan-ruble. The dollar's share of global reserves has been declining for decades. It was over 70% in the 1990s. It's lower now. And every time a country shifts even a small percentage of reserves out of dollars and into gold, it adds buying pressure to the gold market. This isn't a conspiracy. This is just game theory. If you're a central bank watching the US weaponize the dollar through sanctions, freeze Russian reserves, and print trillions to finance deficits, you start asking yourself, how much of my reserves should I hold in an asset that another government controls? And the rational answer is, less than I do now. Okay, quick check-in. Still with me? Good. Because what comes next is the part most people never hear about. There's a fifth element, the wild card: Fort Knox. Trump ordered an audit of Fort Knox gold reserves in February 2025. Fort Knox holds 147.3 million troy ounces. That's roughly 59% of the US Treasury's total gold. Total US gold reserves are 261.5 million ounces, which equals 8133.5 tons. Here's where it gets interesting. The US officially values gold at $42.22 per ounce. That valuation hasn't changed since 1973. At the current market price of roughly $4,900 an ounce, a revaluation would unlock approximately $1.28 trillion. And here's the kicker: revaluation would not require congressional approval. The Gold Reserve Act of 1934 gives the Treasury Secretary the authority to do it unilaterally. Treasury Secretary Bessent said in an interview that he wanted to monetize the asset side of the US balance sheet. Later he walked it back, saying, "That's not what I meant about gold specifically," but he said it. And the fact that he walked it back tells you the idea is on the table. The last full audit of Fort Knox was in 1974, over 50 years ago. So there are two scenarios here. If the audit reveals that gold is missing, you get a global confidence crisis in US financial credibility. Gold spikes. If the audit confirms the gold is there and the Treasury revalues it to market price, you get a massive dollar credibility event because it signals the US is preparing to use gold as a monetary backstop. Gold spikes. Either outcome is bullish for gold. That's the wild card. Now let's talk about something that broke in 2025. The correlation between gold and real interest rates. Historically, gold moves inversely to real yields. Higher real yields mean higher opportunity costs for holding non-yielding gold, so the price falls. Lower real yields mean lower opportunity cost, so the price rises. That's the textbook relationship. In 2025, gold rallied to records despite elevated real yields. The correlation broke. The explanation is this: geopolitical hedging and sovereign diversification now outweigh the opportunity cost of holding gold. Central banks aren't buying gold because of yield calculations. They're buying it because of trust calculations, and individual investors are doing the same. When you don't trust the currency, when you don't trust the fiscal trajectory, when you see sanctions freezing reserves and money printing accelerating, you buy gold regardless of what bonds are paying. CME Group noted in their Precious Metals Outlook 2026 that traditional yield-based gold models may need to be revised. That's a polite way of saying the old playbook doesn't work anymore. This is structurally bullish. Gold no longer needs rate cuts to rally. It rallies on distrust, and distrust is abundant. Total global gold demand exceeded 5,000 tons in 2025 for the first time ever. Total demand value hit a record $555 billion. That's up 45% year over year. Investment demand was 2175 tons, split between ETFs and bar and coin. ETF inflows were 801 tons, second strongest annual demand ever. Bar and coin demand was 1374 tons, 12-year high. Central bank purchases, 863 tons. And here's the supply side. Total supply rose only 1% to 50,002 tons. The World Gold Council called the supply response to soaring prices unexpectedly subdued. When demand explodes and supply barely budges, price has only one direction to go. So where does Wall Street think gold is headed? Let's look at the price targets for 2026. JP Morgan, $55 an ounce average by Q4 2026, rising to 5,400 by end of 2027. Goldman Sachs, 5,400 by end of 2026. Bank of America, $6,000 in coming months. That's the most bullish major bank target. Yardeni Research, 6,000 in 2026, 10,000 possible by 2030. MKS PAMP analyst Nikki Shields, 5,400 by year-end 2026. Wells Fargo is the most conservative at 4,500 to 4,700. Seeking Alpha consensus is 4,800 to 5,000 with a bull case of 5,500 plus. The Wall Street average of surveyed firms is 5,180 an ounce. That's 19.3% higher than the 2025 close of 4341. JP Morgan projects 585 tons per quarter of combined central bank and investor demand in 2026. And they have a rule of thumb. Every 100 tons above 350 tons per quarter equals roughly 2% quarter-on-quarter price increase. Do that math over 4 quarters and you get meaningful appreciation. But let's be honest about the risks, because every trade has a bear case. Kevin Warsh as Fed chair could be more hawkish than expected. If he raises rates or keeps them elevated longer than the market anticipates, the dollar strengthens and gold faces headwinds. Gold's rally has been parabolic. Corrections of 10 to 20% are normal and healthy in bull markets. The 1980 precedent is real. Gold hit $850, crashed, and didn't recover for 25 years. The CME can raise margins at any time. They just proved it. That's a weapon they can deploy to force liquidation whenever leverage gets too high. The CEO of De Beer Group warned that central banks under financial strain could liquidate gold reserves. If that happens, you'd see a supply surge. If the strong dollar trend resumes, gold faces structural resistance, and gold generates no yield. In a high-rate environment, the opportunity cost matters. After a 63% gain in 2025, gold's 30-year average annual return is only 8%. That suggests the 2025 move was abnormal, and mean reversion is possible. There's also the risk of a crowded trade. Everyone is long gold right now. When everyone is on one side of the boat tips. Those are the risks. They're real, but here's what you need to weigh them against. The 4 structural drivers we just walked through: central bank buying, Western investor demand, the US fiscal crisis, and de-dollarization. Those aren't sentiment, those are math. Central banks bought 863 tons in 2025. They've publicly stated they're going to keep buying. $89 billion flowed into ETFs, and money managers are still underweight. The US debt is growing at $8 billion a day, and interest payments are approaching $1 trillion a year. BRICS just launched a gold-backed settlement system, and bilateral trade is moving out of dollars. None of that changed because Kevin Warsh got nominated or because the CME raised margins. The January crash was a liquidity event. It was forced selling by leveraged traders who couldn't meet margin calls. But the underlying thesis, the reason gold went to 55.86 in the first place, is intact. Now let me tie all of this together, because when you see how these pieces connect, everything changes. Gold isn't rallying because of inflation expectations, it's rallying because of trust erosion. When central banks diversify out of dollars, when investors flee to hard assets, when countries build alternative payment systems, they're all saying the same thing: we don't trust the current monetary system to preserve value. And gold is the asset you buy when trust breaks down. The January crash shook out weak hands. It liquidated leveraged positions. It created a healthier technical setup. And it gave long-term investors a better entry point. If you believe the 4 structural drivers are intact, and the data says they are, then the crash was a gift. The key numbers to remember: gold closed 2025 at 43.41, hit an all-time high of 55.86 on January 29, crashed to 47.45, recovered to roughly 48.50 today. 63% gain in 2025, best since 1979. 53 all-time highs set in 2025. $89 billion in record ETF inflows. 5,000 plus tons of total global demand for the first time ever. 863 tons of central bank purchases. 38.43 trillion in US national debt growing at $8 billion a day. $1 trillion in annual interest payments. 261.5 million ounces of U.S. gold reserves, valued officially at 4222, but worth closer to 4900 on the market. That's 117 times gap. Wall Street's average target for 2026 is 5180. That's 19% upside from here. But the bull case targets go as high as 6,000 from Bank of America and Yardeni. If the structural drivers accelerate, if Fort Knox gets revalued, if de-dollarization picks up speed, 6,000 isn't just possible, it's probable. The question isn't whether gold goes higher. The question is how fast and how much volatility you're willing to stomach on the way. We're in the home stretch, and I've saved something important for the end. Gold's performance in 2025 wasn't an anomaly. It was the market repricing the asset based on a new reality. The old model said gold needs low rates and high inflation to rally. The new model says gold rallies on fiscal instability, geopolitical fragmentation, and currency debasement. Those three forces are accelerating, not decelerating. Every $1 trillion added to the debt, every country that joins BRICS, every central bank that buys gold reinforces the thesis. The January crash tested conviction. It separated tourists from residents. If you sold into that crash, you sold to central banks and long-term investors who understand what's happening. If you held or bought the dip, you positioned yourself for the next leg. This isn't financial advice. I'm not telling you to buy gold. I'm showing you the data, the forces, and the framework. What you do with it is your decision. But when you see 95% of central banks expecting global gold reserves to increase, when you see $89 billion flow into ETFs in a single year, when you see Wall Street's average target sitting 19% above current prices, the signal is loud. The people who understand monetary history, who study sovereign debt crises, who watch central bank behavior, they're not surprised gold hit 55.86. They're surprised it took this long. Because the math has been screaming for years. Your future wealthier self is counting on you to see what's happening before it's obvious to everyone else. 10 years from now, you'll look back at this moment and either regret that you ignored the signal or appreciate that you paid attention. Gold, silver, central banks, fiscal policy, the dollar. What's the next topic you want me to dig into? Drop it in the comments. If there's a financial topic keeping you up at night, tell me. That's what this channel is for. You're not pushing the boulder uphill anymore. You're watching it roll. The only question is whether you positioned yourself in front of it or behind it.